When I was preparing for this episode, doing research and organizing notes, I feel like for the last month, I've been listening to nothing but 80s music to really get in the mood. Did you do this?
Yep, a little bit.
Do you have a song that you feel like it's the anthem for this episode?
Oh, I do actually. I think the song for this episode from the 80s is Should I Stay or Should I Go by Clash. Should I stay or should I go?
Nice. That's for Ross Johnson. Mine is I Want It All by Queen, which actually came out in 1989, which is the year that RJR closed. You ready to do this?
Let's go.
All right. Welcome to the third episode of Season 2 of Backtest, the podcast about defining moments in market history and their timeless lessons. I'm Daniel Gamboa.
I'm Matt Harris.
And we are your hosts.
Before we dive in, a quick reminder that this show is for informational purposes only, and it is not investment advice. Daniel and I may have investments in the companies discussed.
We're picking up where we left off last episode. Remember that Ross Johnson, the CEO of RJR Nabisco, he's fretting over his low stock price. He finally decided to move forward with a leverage buyout and presented a bid to the board of directors backed by Shearson Lehman at $75 a share. But before we dive into how the board reacted to Ross's bid, I want to read you, Matt, a quick excerpt from an infamous interview that Ross gave to Time magazine a bit later in December. And the Time interviewer asks Ross, quote, "Members of the RJR Nabisco board of directors have described you as an inside raider because you initiated a leverage buyout as the company's chief executive. What is your response?" And Ross replies, he says, "The obvious response is no, but why no? I haven't been the most orthodox CEO because I figure if you always run by tradition, I would probably still be an accountant for the General Electric company. In 3 years, we averaged earnings up nearly 70%. Nothing happened to the stock price. Then we had Black Monday, stocks went down. It really became evident that this business, especially the tobacco business, should be run as a private business. The shareholders, who are the people who invest in this thing, aren't making it. I went to the board on Wednesday night, October 19th. All members of the board were there. I said, I'm not going to do this unless you tell me to go ahead. They studied it for an hour to an hour and a half and came back and said, Russ, is this frivolous? And I said, define frivolous. They said, not frivolous would be anything north of the highest that the stock of this company has ever traded at. That's about $71 per share. And I said, it is north of that. They said, well, then you should make the bid. So you can tell here, Matt, that Ross is a little bit frustrated, when he's given the interview and telling the story. And so you can infer from his answer some of what's about to happen. But let's not get too ahead of ourselves. Let's go back in time to that fateful day in October 1988. And before we jump into the story, a quick thank you to our presenting partner, EQT Corporation.
At Backtest, we study market cycles because patterns from history rhyme. Whether it's unlocking capital with high-yield bonds and private equity or unlocking the energy needed for AI applications, understanding history gives you an edge.
That's right. And the company unlocking energy to power AI is EQT, producing American natural gas to help deliver affordable, reliable energy at scale. So now we're at Wednesday, October 20th, 1988, and Ross lays it all out for the board. They're proposing to take RJR Nabisco private at $75 a share. And some from the board are expecting it. They've heard from Ross, and he had sort of back-channeled this with them. To others on the board, it's a surprise, and they're worried about their director pensions and basically what do they get out of this. But the biggest catalyst is that they're going to have to issue a press release the next morning as the board, start to evaluate this bid. That's standard procedure. This is material information. The board is going to engage with it, which means that they could theoretically accept it, and securities rules and stock exchange norms effectively make you tell all investors at once. So you minimize the potential for a few insiders to benefit, or you might have a leak. And Ross Johnson should be super worried about this press release because it's going to put the company in play, but he's not. He's almost giddy that morning. He and his advisors don't think anybody else can do this deal. And he thinks that this is finally the solution to his stock price problem, right? Like he's going to be finally happy. He's going to have made it. He's thinking about this as a solution the way that Jerome Kohlberg used to think about his bootstrap deals. Ross gets to keep control, which means no one's going to tell him what to do or to get rid of his perks. He's solving the problem for his shareholders who are annoyed that the stock price is so low and the market isn't giving them credit. And Ross thinks he's giving his shareholders a 30% plus return overnight by taking them from about $50, $55 a share to $75, which is higher than RJR has ever traded. And on top of being the shareholder's savior, he and his management team are going to pocket a couple of $1 billion in the process over the next couple of years. How great, right? Like, this is amazing. Checks every box. But they're about to find out how much they've underestimated the game they're playing, because anyone who feels left out of Ross Johnson's deal is going to come back with a vengeance. So that next morning, Thursday, October 20th now, Henry Kravis is on the phone on another deal in his office when his assistant comes in and she hands him a note that says, quote, RJR going private at 75 a share, end quote. And Henry Kravis almost drops his phone. He's speechless. He's absolutely livid about this. He feels like they're the ones that gave Ross Johnson the idea, and he didn't even have the decency to meet with them about it, which in my mind is a little self-aggrandizing, right? Because the idea was in the air, but the biggest, most credible partner in LBOs, Henry Kravis, is now indignant that Ross excluded him from this deal.
I think one really important factor here, right, is KKR just raised a new fund. And the whole point of this new fund and their response to competition was they're going to move way up market.
Yep.
It's going to be an issue with his customers if he's not even around the table for the exact type of deal he told them he would be doing with this huge fund they just raised.
Yeah, if somebody else can do this deal, then what is the differentiating factor when KKR goes and raises their next fund, right? What's the story they're going to tell? By the way, Henry Kravis is also shocked at the price because they had done a ton of analysis and they had a model for RJR Nabisco, and he thinks 75 a share is way cheaper. These guys are stealing the company. The other guy who's floored is this guy, Jeff Beck, who is a banker at Drexel, who had been chasing Ross Johnson about a leverage buyout for a really long time. And he can't believe that he's not in the tent on this deal advising RJR Nabisco, right? Who does an LBO in the 80s without Drexel in their corner? They're the owner of the high yield market. They can raise the most money. Everybody goes to Drexel. You want them in your corner. And Jeff Beck gets a call from Henry Kravis that morning, and Henry's still trying to process and piece together what's happening. Beck doesn't know much about what's happening either, so he calls Ross, and apparently Ross tells him, quote, we've already got our primary partners on this, Jeff, and that's that, which is crazy.
Yeah, so this conversation really stood out to me because this guy Jeff Beck is an interesting character in the history of Wall Street. His nickname was the Mad Dog, which is now the nickname I aspire to. So if anybody sees me out there, I'll be responding to the Mad Dog.
You got to earn it.
But so in the 80s, Jeff Beck ran hostile takeovers and M&A for Drexel, and he was known as being extremely aggressive / crazy. Hence the nickname. And he was kind of this mythical creature on Wall Street is how I interpret him. There were these rumors out that people just kind of accepted as fact that the Mad Dog was former Special Forces. And in between deployments for Special Forces, he would live in the jungle of Vietnam. And that's like why he was so crazy, right? So this conversation, even more so than the Kravis conversations, really shows that Ross is starting to swim in some very deep waters and he doesn't even know how to swim, right? Like this is not a genteel group of retired people on a board. This is the Mad Dog. And he's starting to piss some people off now.
Yeah, there's another colorful story in the book about Jeff Beck eating some dog biscuits that Ross Johnson brings to a meeting just because, Ross is a jokester and he's like, oh, your name's the Mad Dog, so I'm going to bring you some dog biscuits. And Jeff actually eats them. And on top of that, did you know that Jeff Beck is in the movie Wall Street? I don't know if you remember the scene where they're in a boardroom with the board members and they're analyzing this merger. And there's a guy that is kind of browbeating the people on the board to like get on with it and do this deal. The guy browbeating the board members is Jeff Beck.
Oh, wow.
He's in the movie, yeah, which is crazy. But yeah, he's a legend. Back to the story. Ross's camp realizes that it probably isn't a good idea to have Mad Dog Beck and the Drexel team angry at them. So one of the guys from Ross's team, this guy Jim Welch, who's the chairman of the Nabisco unit inside RJR, he calls Beck and he asks that Drexel just be their friends on this. That's a quote. Be their friends on this. He's basically asking them to sit on the sidelines and cheer them on, which is so naive, right? He clearly doesn't understand bankers or how this game works. And this pretty much guarantees that the Drexel arsenal, this massive amounts of financing and high yield power from Michael Milken, they're going to be pointed at them from the other side of the table, right? This is a really bad move to have alienated the Drexel team. And pretty quickly, Henry Kravis assembles a bunch of key people at KKR, a bunch of advisors to help him decide how they're going to play this. And he starts getting really worried that the deal is going to move fast and that they won't be able to react. He's taking these guys very seriously. He knows the playbook. He knows that 10-week plan that we talked about a bit ago. And he's worried that this merger agreement with the board is going to go so fast that they might not even be able to go compete. And in particular, he's worried about being locked out of bank financing. So the way these deals get financed usually is a firm like KKR puts up some equity, maybe 10, 20%. And then a firm like Drexel will line up high yield financing as the next tranche of risk capital in the cap structure, maybe another 10 to 30% of the deal. But the bulk of the financing, 50% or more, comes from a bank, right? A traditional bank. And at that point in the 80s, there are really mainly three banks that count for leverage buyouts: Citibank, Manufacturers Hanover Trust, and Bankers Trust. And one of the main things that Kravis is worried about is Ross Johnson and Shearson Lehman locking these banks into exclusivity for their bid on RJR. Because if they do that, that basically means nobody else can get financing and nobody else can do this deal. So they'll have no competition. Kravis is also worried that the board of RJR might be in Ross Johnson's pocket. And if that's the case, KKR really needs to force them to consider them as a potential buyer before they sign any sort of agreement on the management bid. And so Kravis convenes his advisors to the KKR boardroom on Sunday afternoon, and they consider three options. The first one is, maybe we should go meet with Shearson Lehman and figure out a joint bid. Like, can we just partner on this? The second one is sending what's called a bear hug letter to the board. This is a bit of an aggressive tactic where the buyer sends a buyout letter to the board of the target company with a takeover price that has a premium to the current trading price. And the goal here is really to force the board to react so that they don't just dismiss the offer. And then the third option is going hostile with a tender offer directly to shareholders. So this is now not a letter to the board, but this is a public open invitation to anybody who owns the stock to sell their shares to the buyer, again, at a much higher price. And the key element of a tender offer is that it bypasses the board altogether, right? You're going directly to shareholders. Meanwhile, not too far away from the KKR offices, the team at another major bank, Salomon Brothers, which is an investment bank like Shearson Lehman, they're also trying to rescue their firm. You talked about the 1987 crash. One of the things that we haven't mentioned is that the volume of stock trading went down significantly, which means all these Wall Street firms are hurting for revenue. And so they're all trying to build a big investment banking M&A franchise so they can make more money. So Salomon is also preparing a tender offer, and they're trying to look for a way into the deal. And at this time in 1988, Warren Buffett owns 12% of Salomon Brothers. And so Jock Gutfriend, who is another Wall Street legend, and he's the chairman at Salomon at this point, he calls Buffett and he asks him, hey, what should we do here? And Buffett tells him, go for it. Go do the offer. Go do the tender offer. Buffett is a really shrewd operator, though. He doesn't want to participate in the deal directly because of all the social and kind of PR baggage. But he thinks tobacco companies are great businesses. He says that cigarettes cost a penny to make. You can sell them for $1, and they're addictive, and customers are brand loyal, which, by the way, this is kind of like the same thesis on Coca-Cola, right? Except maybe, Coca-Cola is not as bad for you as a tobacco company, but it's the playbook of Berkshire.
Yeah, it probably was as bad for you when it had cocaine in it and they took it.
That was
Yeah, one interesting thing I learned about this conversation with Solomon and Warren Buffett is Warren Buffett does end up owning some of the RJR Nabisco stock temporarily in a merger arbitrage trade. So he bought some of the stock kind of around the time of this conversation just to benefit from what he thought was an almost certain transaction.
Yeah. What's interesting too is that I think a lot of people are looking at this and saying the company's in play and chances are this is going to go higher and there's going to be a bidding war. And so I think a lot of people are probably piling into the stock at this point. And the way this is all playing out is really emblematic of what's about to transpire here in the story, because Ross Johnson and the team at Shearson Lehman could not have underestimated the game more. Not only does everybody else on Wall Street want a piece of this deal, they see it as existential that they participate in it, right? On the one hand, the potential fees are enormous, whether you're in as an advisor or financing the deal or you're an investor, pretty much every role. But also the halo to anybody who's in this deal, the reputational upside is massive. This is by far, at this point, the biggest deal ever. Meanwhile, while all this stuff is taking place and people are trying to figure out if they're going to compete with this management bid that just got made public for RJR, there's a special committee of the board that gets formed. And this is typical when there's any sort of strategic transaction that's being considered by the company. The board will assemble a subset of directors and put them in a special committee to evaluate the transaction or whatever strategic initiative, and then make a recommendation to the broader board to finally vote on it. And so this special committee is evaluating the bid from Ross Johnson and Shearson Lehman. And the lead director for the special committee is the guy we talked about earlier, Charles Hugel. This is that old school kind of no BS buttoned up guy that was pushing back on Ross earlier. And they're being advised by Lazard, which, remember the investment banker that took Ross to play golf with Don Kelly? So that's these guys. And then another investment bank, Dillon Reed. And they're being advised by the law firm Skadden. All of them are shocked by what they find in the boxes of data that they're getting in order to evaluate the fairness of the $75 bid. The boxes have the reports that Ross had commissioned from some of the consultants, and all these reports have valuations on RJR, pretty detailed, and none of them have the value below $80 a share. In fact, most of them are closer to $90, and one of them has the valuation going as high as $111 a share. And so naturally, all these advisors and the directors on the special committee are thinking, Ross is crazy, right? Like, is he trying to steal the company? And now Pandora's box is open, and Ross Johnson doesn't quite realize it. Maybe it's starting to sink in by this weekend in October, a couple of days after the press release, that he is in way over his head, playing a very technical strategic game that he's not really ready for.
Yeah, this is really setting up to be kind of like a lightweight versus heavyweight boxing match. And so the next move in Kravis's attack is going to be to bid $90 a share in a tender offer, which is well above where Ross Johnson has bid at $75 a share. It's 20% higher than the other bid in the market. And actually bidding so far above where Ross Johnson had bid is actually pretty crafty. And so you're starting to see the KKR, more experienced team come through here. One reason it's crafty to bid so much higher than Ross Johnson did is it makes Ross Johnson look greedy, right? It makes it look like he's trying to steal his own company, like he's got inside information, and he's gonna use his insider status and coziness with the board to just get a really sweet deal. The KKR is starting to drive a wedge through Ross Johnson and the board. The second reason that the tender offer is a pretty crafty move at the time is it is a guaranteed KKR response from the board, right? The board is actually required by law to respond to a tender offer. And Kravis's main concern is that the Shearson and Johnson deal is going to move so quickly to a merger agreement that they're not going to be able to kind of get their foot in the door to be a part of the conversation. And so given that, a tender offer was clearly the best response from KKR. And then in terms of studying KKR's strategy in this bid, in addition to clubbing up 4 of the top investment banks, which is a lot, right? Normally you have 1 or 2, because when they're working for you at KKR, it means they can't work for anybody else.
Yeah, they're conflicted out.
Yeah, so KKR brought in way more banks than normal. In addition, Kravis made this very aggressive and uncommon move where he actually goes to one of the banks, manufacturers Hanover, and he locks them up into exclusivity, which is very uncommon. One of the things I find funny about the 80s is calling all these financial firms nicknames became a big deal. Manufacturers Hanover is my favorite nickname. Everybody called them Manny Hanny, which is just
I hadn't heard that.
fun to say. It's like Drexel and Solomon and all these shortened names, and then Manny Hanny, which
Manny Hanny.
Yeah. I can just see people yelling that on the stock exchange floor.
That could be your name, Matty Harry.
Yeah, it could work. I like the Mad Dog more, but we'll see what
what
the
sticks.
people want. At this point in the deal, KKR's biggest concern is their investors. So they have this newly minted $5.6 billion buyout fund that was the first true mega fund ever. It's 2 times bigger than the next biggest fund. And even though this wasn't technically a hostile takeover, because KKR actually made their tender offer contingent on the RJR board's approval, it was pretty close. And most pension funds, they're not just leery of hostile takeovers. A lot of pension funds at this point were barred from them because states had started passing laws, limiting high yield and limiting hostile takeovers. And so KKR is in this interesting spot as a business where they kind of have to do the deal for their franchise, but they also need to be really careful with what it brings on by doing a big deal that's perceived as hostile. And it wasn't just KKR that got stirred up by this press release about management's bid. The whole street just kind of stopped and to do this deal, to see who would win, to watch in awe at the largest LBO in history. Specifically, a private equity firm called Forstmann Little jumps in on the bidding, partnered with Goldman Sachs and a syndicate of corporate backers, like actually Procter and Gamble was in their group. And then First Boston, or First B in 80s language, they joined into this food fight. And their goal was similar to Shearson in that they wanted to plant their flag in the ground in the buyout world. They wanted to make a huge splash in their first time in the pool. And with that, this is a great time to thank our presenting partner, EQT.
In essence, leverage buyouts are ways to rethink and optimize not just the capital structure of a company, but also its business operations, management's focus, and execution speed. Like high-yield bonds, they widened the menu of options for companies to operate with rigor in the 1980s.
That's right. And operating with rigor to deliver the natural gas to fuel the AI boom is a key focus for EQT. EQT is focused on the infrastructure that makes growth possible, building and modernizing the energy systems that deliver affordable, reliable power where demand is rising.
Which matters because the AI boom isn't just about models and compute. It's about whether data centers and digital infrastructure can actually get the baseload power they need with uptime and efficiency.
That's the unlock EQT focuses on. EQT supplies energy to the infrastructure that bridges breakthrough technology and real-world scale.
To learn more, go to poweredbyeqt.com and be sure to follow them on X and LinkedIn. Big thanks to EQT for helping us bring you the stories of market history and how they apply today. So back to the story. Everybody and their brother is trying to get in on this deal. And while all of this is happening, all these sharks are kind of circling around RJR. Ross Johnson is over there trying to play politics. He's trying to charm everyone. He's playing checkers while everybody else is playing chess, really, because no one else except Ross here is thinking, hey, I'm a good guy. You're a good guy. Let's just be nice and do a deal. That's not how Wall Street works. This is zero sum. It's like a closed cage knife fight. And these guys all take this personally and existentially. Everybody starts to take Ross less seriously because of his approach to the deal. They see the way he's trying to play this as a surefire way to lose. So they respect that he has one ace in his hand, right? He's the CEO of RJR. But otherwise, they start thinking he doesn't really know what he's doing. And in some ways, the last straw that breaks Ross's credibility in all of this, or at least the trust of, in particular, the RJR board, is an article that gets published in the New York Times on Saturday, November 5th. And the title of the article is Nabisco Executives to Take Huge Gains in Their Buyout. And the article talks about how the management stake might be worth as much as $2 billion. Ross reads this over the weekend and he thinks it's nothing. He thinks, yeah, the incentives are big, but only if they meet certain milestones. And, the higher the bid price gets, the less the management team gets. But the optics of this are horrible. And there's really no nuance in public narratives and public perception. Charles Hugel, the lead in the special committee, he's getting angry calls from other directors demanding an explanation from Ross. All of them are worried about looking foolish out of this. They feel like Ross turned the company into a circus. And it's really not just the board and the media that's turning on Ross Johnson at this point, but also shareholders and employees. The RJ Reynolds people in Winston-Salem already didn't like him, like we talked about. But now really the whole company is losing faith in him. You kind of touched on this earlier, but the whole country is tired of chaos from these buyouts by 1988. And now they have somebody who, at least in these articles, seems like the embodiment of selfish greed. Basically somebody looking out for himself at the expense of the shareholders and at the expense of the people on the ground in these communities actually making things, while these guys, the executives, just fly around in private jets. Even people like Fed Chairman Alan Greenspan and Senator Bob Dole, even people like that are looking for ways to curb LBOs through either regulation or new bills in Congress. It was so bad, actually, for Ross that even his own advisors are wondering if he was more trouble than he's worth. Like, that's how low he's sunk by this point. And actually, he's feeling pretty low, too, by now. He kind of stops caring. He's starting to think maybe this isn't worth the fight. It's all pretty stressful. Now it's this very competitive process. He doesn't really know how to play this game. One of his own proteges, in fact, this guy, John Greenhouse, who is the president of Nabisco, who had been left out of the LBO concept. And his main concern, he's one of these guys whose main concern really is the company, Nabisco, the company. He goes with a little bit of guerrilla warfare and presents detailed ways to boost the operating margins at Nabisco, first to the special committee and then to KKR. So he's kind of going behind Ross's back to help people that are bidding against him. So by this point, Ross is getting attacked from all sides, and he doesn't even know it. He doesn't even realize it.
Yeah, so what started with Ross Johnson's $75 per share bid, with him kind of in the pole position, everybody thinking he's cozy with the board, nobody's going to do a hostile takeover. It's really changed now. KKR is tendering for shares at $90 a share. With Forsman Little and First Boston are now in the picture, and so we have an auction on our hands that can really only drive the price higher. Worth noting, right, that the stock itself before all this was in the 50s.
Yeah.
And so I remember I mentioned earlier, one of the things that drove the market higher in the 80s was a ton of M&A at higher prices. This is a great example of something that just kind of drove the market higher through the 80s. This exact thing happened a bunch of times. And so it's worth pausing for a second and just, what drives a bid higher in an auction? How were these investors thinking about the prices they were paying? What was in their minds? And so the first thing that I think to mention that drives bids higher is just thinking about like what return is required by the investor. An investor that needs to earn a 10% return can just pay a higher price than an investor that needs a 30% return. And so, in this case, given these are all LBO firms, it's fair to assume that all the bidders in the RJR Nabisco auction had pretty similar return requirements. The second is, what does the investor think this company's debt capacity is? The more debt a buyer can put on a firm, the less cash equity they have to put in themselves, which really just kind of torques things to the upside and creates potential for windfalls. So take that business, Gibson Greetings, that I mentioned earlier, where they bought the company for $80 million, but only put in $1 million of cash equity, and they used $79 million of debt to get to the 80. So they sold that business for $290 million about 17 months later. And assuming that all the cash that didn't pay back the debt went to the investors, they made a 211 times return on that deal. And so perceived debt capacity is important. Another really key thing in this that's really important for this particular deal is what the buyer plans to do with the company and how that impacts their willingness to pay a higher price. To use an extreme example, if the buyer's plan is to just sell each division of the company, they already have a buyer lined up for each company, then they'll be willing to pay a price that's kind of just below what price they've locked in to sell the business. Or on the other end, if the investor plans to operate the business for the next 10 years and create returns for shareholders through reinvesting and paying out dividends, then it would really need to calibrate its price towards those projections. And normally, the person who's going to run the company for a long time, there's a lot more risk in that. And so that price is probably going to be lower. And a lot of those cash flows are coming later on too. And then there's also a lot of other people in these deals beside the buyer and the seller, especially in this particular deal. And so bankers get fees when they do deals. They get fees for advising, they get fees for making commitments, they get fees for actually funding the deal. And so those second two, right, fees for commitments and fees for funding the deal are actually what's called percentage of proceeds based. And so the bankers are incentivized to push for bigger and bigger deals because they're getting a percentage of the deal size. And so they want bigger and bigger deals. And then, one huge factor in this particular auction is that KKR had just raised their 1987 $5.6 billion mega fund, where they told their LPs, we're going up market, right? We're going to go do the biggest deals that nobody else can do. If they lose the biggest deal and then it goes well, then they've got major egg on their face versus winning the deal is a little bit of just doing what they told their LPs they would do with the money. And in all of this, of course, it's important not to lose sight of what RJR Nabisco's board cared about. The board considers more than just kind of the raw price offer in this. They consider, certainty of closing and the timing of closing and the structure of the deal and anything they need to do to adjust the price being offered with the chance that the bidder can't raise the required amount of money in a short amount of time. If someone bids 10 times higher than the second highest bidder, but the board doesn't think that bidder can raise the required money anytime soon, then they're actually obligated by fiduciary duty to go with the second highest price.
Yeah, exactly. And there's a whole fascinating amount of case law that gets established in the 80s as a result of a lot of the corporate raider era plus LBOs. This is really where boardroom law and precedent comes of age. And so if you go into investment banking or private equity or anything like that, there are a lot of things, a lot of cases that you end up referring back to even to this day, Revlon and Unical and others. And to a large extent, boards are evaluating bids on the merit of maximizing value for shareholders, but there's other things that they take into account, like certain deal closing and also what things might affect employees and communities that the company operates in. By this point in the RJR deal, the one constituency that the board is getting really tired of is Ross Johnson and his advisors. Meanwhile, you have KKR with an army that includes Drexel, and you also have several other groups, like you said, with Frostman Little and First Boston in the mix. Frostman ends up coming to the conclusion that a $90 a share or higher offer is not going to be financeable without junk bunts. And so they buy out on principle because they don't believe junk bunts are good. They're adamantly opposed to them. They think they fuel excessive leverage in companies. They call them sugar highs for companies. And by the way, Ted Forsman, the founding partner of the firm, is the one that coins the phrase barbarians at the gate, describing KKR as a buyer for RJR. Forsman is really high on his horse at this point in the story, and he's getting ready to get on a soapbox and issue a public statement denigrating the process because you can't do this deal without junk bunts. And Charles Hugel on the special committee threatens to issue his own public statement denigrating Forsman if they do that. And so Forsman kind of backs off and just leaves the bidding with a bit of a whimper, which I think this sheds light into board dynamics and the way these deals go. This isn't just emblematic of the 80s, by the way. These kind of social tactics and like aggression in these deals, this happens every day. The special committee at this point sets a deadline for all of the serious buyers to submit their bids for evaluation by Friday, November 18th. This is basically saying best and final, give me your offer and we're going to make a decision. There are actually several less than serious bids that come in, funny enough, random kind of stockbrokers and just people that mailed letters in for like a $28 billion bid without any real financing or any credibility. This might just be a guy in his backyard writing a letter to the board. So these guys are kind of laughing at these, but like everybody and their brother's paying attention to this deal. The two serious bids at this point are Russ Johnson, the management bid, which by now has increased to $100 a share, and KKR, which has increased to $94 a share. They are structurally a little bit different, and we'll come back to that in a bit. But there's one more bid that comes in, and it's a wrench because First Boston decides to bid a range. They didn't have enough time to fully flesh this out, but they bid a range, and they claim that they need a little more time to land on a single number, but they say they can bid 105 to 118 per share, which is, much higher than anything else. And they say that they can get there with this quirky tax idea that creates a couple of $1 billion in extra value. And this bid is kind of what takes something that was already a bit of a circus and a very contentious deal into like full-blown P.T. Barnum, Cirque du Soleil style pyrotechnics here. So Russ Johnson and his team thought that for sure $100 would get it done. Everyone else outside of this deal, everybody who's watching, thought for sure KKR would figure out a way to win this. And instead, now it's First Boston who comes in the lead with this quirky but actually credible tax idea. And the committee, advised by their counsel, of course, and in a state of exhaustion, should I say, like the book goes out of its way to say at this point, the special committee is pretty tired and there's a bit of frustration that this is carrying on and maybe they're looking foolish. They're worried about lawsuits. And this process is so far out of the fairway of typical board situations that they're reacting as they go. The special committee comes to the conclusion that they need to hold a second round to try to normalize all the bids, basically put them on equal footing and try to get to a decision, try to figure out who the buyer is going to be. In a way, this saves KKR because otherwise the board would have probably just picked the management bid, Ross Johnson's bid, and moved forward. But because First Boston's bid was so much higher and because it was a little bit shaky and they needed more time to finalize it, this ends up pushing the process to another round, which gives Henry Kravis and KKR not just another life, right, but a chance to play into the new deal dynamics and send a signal that, hey, maybe they're not sure if they're still in at these price levels. So it really plays into KKR's hands. And by this point, the deal is so big that you mentioned everybody's watching, right? We talked about how everybody's watching this on Wall Street and in the markets. All the banks are waiting to see what happens before they commit capital to anything else. Traders are tapped out on their credit lines, on their trading limits. The way Barbarians describes this is like an old Western movie when all the townspeople go really quiet and everybody's watching the duel between the big gunslingers on Main Street. That's kind of what it felt like, is how they characterize it. Henry Kravis and his cousin George Roberts end up landing on a strategy of making everybody think that they're going to drop out by telling their investment bankers that that's where they're leaning. They're basically telling their advisors, "Oh, we think we're not going to participate," knowing full well that their bankers would probably talk to somebody and it would kind of trickle up to Ross Johnson and Shearson Lehman and the RJR board. And so they're playing games and it works. Kravis wasn't going to go anywhere, right? Like he wasn't going to sit on the sidelines on this. They end up coming in that second round at 106 to top the management bid. And Ross Johnson with Shearson Lehman, who, by the way, had partnered now with Salomon. So Salomon's on the side of the management bid. They go up only $1 to 101. Meanwhile, First Boston is still kind of a long shot with their quirky range tax bid, but they're still in it. And they get a letter from Citibank saying that their tax structure is doable. So they're vouching for it. The KKR team gets called into the Skadden office where they're reviewing the bids with the special committee of RJR. And one of the lawyers comes in and basically says, "Hey, is 106 your best offer?" They say yes. The lawyer says, "Okay, if the committee can get comfortable with the financing, they're going to recommend the KKR bid." And at that point, Henry Kravis, George Roberts, the whole team is excited, maybe a little relieved. They think they've pulled this off. But wait, not so fast, because Shearson Lehman and the management team are expecting to win this, right? They thought that Henry Kravis was out. They thought he wasn't going to bid again. That's why they only went up $1. And now they're losing their minds when they don't get a call that night. They don't know yet that they've lost, but they don't get a call. They finally get through to the lawyers that are working for the special committee. And the lawyers tell them, "We're not going to need you tonight. You can go to sleep." And that's like a telltale sign, right? That you probably didn't win. Minutes after that call, apparently, they found out that Henry Kravis has been called over to their office. And now they know, right? Like now they know that something's happening. KKR probably went up enough and we may have lost this. And then they hear that there may be a press release issued in the morning. And so now they really know they lost. Ross Johnson is ready to throw in the towel. He's ready to give up. But Peter Cohen from Shearson refuses to concede. He's like, "We're not letting this go. This is our flag. This is going to be ours. This is our deal. We need to do this." He wants to know the exact number and the structure from KKR to see if they can top it. Forget the bidding rounds, right? Like forget any norms. He wants to know if he can go win this still. Around 3 a.m., the KKR team hears that the Wall Street Journal is going to publish a story saying that the management team bid 101 and KKR is at 103, and that there's speculation that the management team might bid again. And Kravis is livid, right? He can't believe it. He thinks he has this in the bag, and he can't believe there's another leak. He can't believe that the Skadden lawyers are playing games again and maybe opening the bidding process. And, of course, Henry Kravis himself would have probably played the game the exact same way if he were on the other side. He wouldn't have let go of this without a fight. So he and George Roberts put a deadline on their bid. They say by 1 p.m., if you guys have not signed the agreement with us, we're going to walk away, right? We're going to limit the amount of time that Shearson has to actually submit their bid. And it doesn't matter because Shearson moves super fast. And by that morning, they submit a bid for 108. So now they're in the lead. But Kravis at this point doesn't panic. He kind of sits back. They extend their deadline, but they get a concession out of the board, which is wild to think about. The board says that if KKR stays in the game as they evaluate all this, they'll pay their expenses to date, $45 million. That's what Henry Kravis wants. The board says yes, which is a huge give. But like, what are you going to do, right? If you do the math on this, each dollar per share is worth a couple $100 million. So to you as a special committee, you probably want, okay, just give us a bit of time. We're happy to pay $45 million if it means $200+ million worth of value. And things get really dramatic and really tense because both camps are in the same building. They're actively lobbying the directors in the bathroom. They're spying on each other, trying to figure out what each other is doing. And they go really late into the night again. And the Ross Johnson / Shearson team lands at $112. KKR stretches to 109 that night after a lot of back and forth. But the Shearson offer has some structural elements in the financing that are a little bit riskier. So if you discount those, management team's at 112, discount that, it's basically the same as the KKR bid at 109. And the question now is, how do you differentiate between these if you're on the special committee?
Yeah, so this part of the story is really intense, and I thought it was funny in the book. Every time the board of directors would leave for a bathroom break, they're all men, and they'd be at the stall, taking their bathroom break, and they'd just be surrounded by associates from all the banks that were kind of around the deal, and everybody's kind of like, "Hey, what's going on in there?" So at this point, the board, they have a dead heat on their hands, and try to put yourself in their shoes at this point, right? You've been cramped in this boardroom for, it feels like days. It's super late at night. Your family's at home calling, being like, "Where the heck are you? You're just a board member of this company."
You're getting
And
hassled when you go into the bathroom.
yeah, yeah,
You're probably running on pizza.
right. And it's important to keep in mind, right, that this process of selecting a bid is sort of surrounded by legal issues. And in the book, Barbarians at the Gate, they make a big deal about this in the board meeting. They're like, "Guys, we're gonna get sued over this. Like, it's just a part of the game when you're in a process like this." And so they make a really important point of, like, dotting all their I's, crossing all their T's, doing this in the right way. Just keep in mind that this is a legal body, right? They have real fiduciary duty to represent the shareholders. So in the case of KKR and the management team's bids, the board had formally concluded, through the advice of their outside counsel, right? So they're following the legal process, that these bids were equal, right? They were toe to toe from a shareholder value perspective, and this allowed them to put heavier weight on other factors than just the shareholder price. It allowed them to take a big step in the direction that they wanted to take away from Ross Johnson, right? Because nobody likes Ross Johnson at this point. They don't want him to run the company, and they're all kind of leaning towards KKR as a better bid anyway.
Yeah. They don't want him to walk away with $2 billion too, right? I think everybody's sick of the management agreement being so one-sided.
Right. KKR was offering more of the things that the board wanted to see. For example, KKR is leaving more stock in the hands of RJR Nabisco employees so they can participate in the upside going forward. KKR only planned to sell a small portion of the company versus management's plans were to sell the entire tobacco business immediately. And the board just felt a lot more comfortable with how KKR was going to treat employees and with the leadership KKR would ultimately put in place, which really was just anybody but Ross Johnson was kind of what they were thinking at this point.
Yeah.
So late at night on November 15th, 1988, they finally call for the final vote on who they're going to select as the winning bidder for the largest LBO in history. And the board unanimously selects KKR. And at that point, it's over. KKR has won the bid. Ross Johnson gets a $53 million golden parachute to go away. The four banks on KKR's side clipped a $386.3 million fee for, just about a month's work.
I thought it was also pretty interesting how they structured this. So KKR ends up tendering at 109 per share, and it's oversubscribed. 97% of shareholders end up tendering to KKR on this. And of course, KKR only wants to take down 74% in that tender offer. And so they end up paying $81 in cash per share. And the rest of it is securities, right? It's $28 worth of a combination of preferred stock and convertible preferred debt to the shareholders. And ultimately, they completely buy out everything and the company goes private and KKR controls it. And the deal closes in February 9th, 1989, just a couple of months after KKR gets deemed the winner in November of the previous year. And this closes the saga of the biggest LBO in history and just a fascinating story of kind of how this company goes private.
Yeah, and it was pretty clear to everybody that it was going to be hard for whoever won this deal to make a good return on this because they paid such a high price, and they didn't make a good return. One article from an academic journal called Private Equity International said this: looking at a recent Kohlberg Kravis Roberts investor presentation, one figure quickly jumps off the page. The buyout giant's worst performing fund, vintage 1987, returned an internal rate of return of just 12%, which was well below the gross IRR of 26% across all its funds and the all-time best fund of 48% from its 1982 fund. And then there's a footnote in that presentation that says the 1987 fund includes KKR's investment in RJR Nabisco, Excluding this investment, the fund would have returned 25.2%.
Yeah, fascinating.
Yeah. KKR increased RJR's debt load by 5 times. They increased the interest expense from $500 million per year to about $3 billion per year. Although, a lot of the way these deals were set up is the interest expense didn't need to be paid for a couple of years. It was kind of the way the deals were structured, and that's actually why Ted Forsman didn't like the high yield market, as it hid those expenses until later on. There's a quote at the end of Barbarians at the Gate that if you ever hear anybody talking like this about investments, you can conclude this is the peak when people talk like this. This is a conversation between Ross Johnson and a Shearson Lehman banker when Shearson wanted to raise their bid to $115 a share. So Ross Johnson says, "My gosh, that's crazy. How could that be a good investment?" And the banker said, "Listen, Ross, they have their reasons for doing this other than just buying the company." He mentioned the $200 million in upfront fees Shearson would reap from a successful deal. He talks about the unmatched franchise benefits they would reap for having completed the largest LBO in history. Johnson's problem was that he insisted on thinking in terms of the real world, real money, real investments. In effect, the banker was saying this isn't the real world. This is Wall Street.
Perfect.
So I learned a lot from this study. The two things that stood out to me as I absorbed the story of RJR Nabisco and the largest LBO in history. One is I was thinking a lot about comparing the academic work behind Michael Milken's junk bond business to the academic work behind portfolio insurance that really exacerbated the 1987 crash. And so they're very different, right? The academic work behind junk bonds was about what had happened in the real world, right? It was just studying the performance of junk bonds for 3 or 4 decades in the early 1900s, versus the academic work behind the portfolio insurance had never been tested in the real world. It wasn't meant to scale. People actually knew that it wasn't going to scale, yet it did anyway. The academic work behind portfolio insurance is completely theoretical, never been tested in the real world. But by January 1987, it had become the first large-scale computer-driven trading strategy. And so I think just thinking a lot about the differences between academic studies and what that means for what you should do with them was a big takeaway. Another big lesson I had was just how important legislation is to large capital flows. I know it's like super boring and nerdy, and that I've probably talked about it too much already, but none of this story happens without ERISA and the clarification of the prudent man rule. And without ERISA, there is no scaled up private equity industry. Studying ERISA in the 80s has me spending a lot more time studying the Retirement Investment Choice Act. That's a bill in Congress today that is going to give 401ks access to alternative assets for the first time, because there's about as much capital in 401ks as there are in pensions, although they're obviously structured very differently. And so that was my other big takeaway.
Yeah, 401ks are the modern day version of the pension fund, right? I agree. Those are interesting. I also love this story because to me, in a nutshell, it really captures the essence of Wall Street and the corporate world, kind of like that last quote that you mentioned from Barbarians. To me, it captures that if you know what you're looking at, there's really no clear separation between Wall Street and Main Street. Like the human element and the power dynamics of the story are so fascinating. The RJR story in particular, to me, highlights how specific individuals, right, like specific personalities drive these major events that affect thousands or millions of people who are really all just along for the ride without any real control, and often even without any real visibility as to why or how these things are happening. And there's nothing nefarious or inherently bad about this. It's just how the world works. It's just how power works and how big decisions take place. And you're really at the mercy of the person who's driving that. And if that's you, if you're the leader, if you're the one that's driving that, hopefully you know, one, what you're doing, and two, you're in tune with your own blind spots. And I've seen this play out during my time in M&A and in private equity and in tech. And the RJR story really brings those dynamics to life. In a sense, you read this and you study this and you get the lessons without the stress of having to live through it, which is always good.
All right.
Should we leave it there?
Let's do it. Thank you for listening to this episode. If you enjoyed it, the best way to help us is to share this with anyone you think might like it, and to leave us a 5-star rating on Spotify or Apple Podcasts. And of course, tune in to episode 4 of our series on 80s Wall Street coming out in a week or two.
See you, Matt.
See ya.